When it comes to private equity deal structuring, we have to face the fact that private equity funds like to structure deals that can appear quite complex. They're doing this in order to solve deal problems, valuation issues, to map out their role in the company post-investment. And the problem we often face is that entrepreneurs and company owners are not very familiar with the deal structures employed by private equity funds. And therefore, this gives rise to a suspicion that the company owner feels that the private equity fund is trying to do something tricky, or it's a tactic to take control of the company by stealth, or a way to for the private equity fund to effectively take over the company. So there's a lot of there can be a lot of suspicion by company owners towards private equity funds and their deal structuring, mainly unjustified. And therefore, what can be the role of the trusted advisor to a company or a company owner? It is to bridge this gap, to help educate the company owner about the way private equity funds structure deals, and on the other side, to work with the private equity fund to help them understand the concerns of the entrepreneur, which may not be formulated explicitly in a one-to-one meeting. So it's all about being a bridge, and in order for an advisor to be able to act as such a bridge between the two, it's important the advisor gets a general overview of how private equity deals are structured, and this is the objective of this module. And so just understanding the structures that are out there, the fact they exist, the general purpose of these structures can go a long way to helping trusted advisors help company owners make the leap towards a private equity deal that can be successful. The main objectives of this module are to explain how private equity and venture capital funds approach deal structuring, what kind of financial instruments they use in putting deals together, what are some of the main obstacles to successful deals, and what are some of the very specific private equity aspects to deals, such as veto rights, flipover mechanisms, escrow accounts, and others. We start by considering how private equity and venture capital funds approach deal structuring. One of the important first things to comment is that PE funds are not afraid to make it complicated. If a deal has complications or problems, making the deal more complicated allows problems to be solved. The investment is a partnership, it's not transactional, so it needs to be a win-win and a sustainable deal and arrangement between the parties. The PE fund is looking to use their expertise and deploy unlimited flexibility in structuring, which many other types of investors are not able to do. The PE investor is looking to align management's economic interests with theirs because it's a partnership for the future. The PE fund has the ability to deploy customized financial instruments and or more than one financial instrument in order to structure a successful deal. They're also looking to kind of turbocharge the influence of their stakes. So whatever the stake they have, they're looking to have an influence over and above the pro rata influence they would have in normal circumstances. And the structure will also take into account the different scenario outcomes, both on the upside and on the downside. What are some of the key skills that are required on the PE side to go into deal structure? Well, it's basically a multidisciplinary approach, and that's one of the key things that PE funds are able to bring to bear. So some of the things that would be looked at would be the valuation of the business. This requires forecasting, accounting, and financial skills. Assessing the future performance of the business. This requires forecasting skills and also a good sense of the sector and the competitive dynamics. Incentivizing management, understanding how to align management's interest with that of the investor, which requires human and HR skills. Anticipating potential misbehavior on the part of management and employees, and this requires control and policing kind of skills. Dealing with succession in management and in shareholders and in the board, this requires human and psychological skills. And due diligence, which requires forensic investigation skills. We now review the type of financial instruments commonly used in private equity transactions. We start by reviewing the full set of instruments which private equity funds commonly make use of when structuring investments. So on the balance sheet side, we start with ordinary shares in the company. Ranking above ordinary shares, we have preferred shares in the company. Ranking above preferred shares, we have mezzanine debt, used often by mezzanine funds. And finally, convertible debt, which is used in some circumstances to structure a private equity deal. As an off-balance sheet item, we have options, which is very frequently an instrument very frequently used by PE funds to resolve deal challenges. What are the variables driving the choice of the financial instrument? It's four factors. One is the ranking in the balance sheet, which the investor is trying to achieve. Are they trying to rank above the seller? Is the capital supposed to be repayable or permanent? In the case of mezzanine, it's obviously repayable. What kind of coupon or regular payment do they wish to have on the instrument, and how do they want to structure it, and what should its ranking be? And finally, what influence on decisions is the investor looking to have? Well, the instruments will have different risk profiles. So equity has the highest risk, and typically the fund manager will be targeting a return of 25 to 35% on this instrument. Quasi-equity, such as preferred shares, would have a lower risk, but still high risk, and they'll be targeting a return of 20 to 25%. Subordinated debt, such as mezzanine, would have a medium risk, and they'll be targeting a return of 15 to 20%. And senior debt, which has a low risk, would have a target return of 5 to 10%. And what the fund manager is trying to do is, in his choice of instruments, is to maximize the ratio of return to risk for the instrument used. Let's start by looking at each financial instrument in turn. So ordinary shares. Well, if we look at ordinary shares from a private equity perspective, there's about 3 levels of investment with different implications for the private equity investor. A minority stake is the least common. This would typically be a stake of maybe less than 15%. It gives the investor little influence. The stake is not very liquid, but if it's part of a larger consortium, it may be acceptable. Many private equity funds will choose to make their investment through an influential minority stake. This would be typically a stake of something like 20 to 49%. It gives the private equity fund strong influence, maybe even effective control in the case of a fragmented shareholder structure on the other side. It leaves enough equity for the sponsors or the management, but it does require the private equity fund manager to negotiate investor minority protection mechanisms. In the case of a majority stake, 50% plus, it gives the investor the most influence. It reduces the need for complexity in the structure because there'll be less protection mechanisms needed. It provides a better stake for sale, but it could demotivate the other side and give too much responsibility to the fund manager, and there may also still be a blocking minority of 25% plus on the other side. Preferred shares, these are also a class of ownership in the company, but they rank higher, so they rank above in a liquidation. Preferred shares usually will carry a coupon which may be fixed or related to profits. This coupon is paid in priority to the ordinary dividend. Generally, preferred shares have lower voting rights in normal circumstances, but they can be customized much more than ordinary shares, and it depends on the jurisdiction in which we're talking about, but they can be customized. And the preferred shares could also convert to ordinary shares on exit so that the investor gets the full upside potential. We could consider a simple example to illustrate the advantages of preferred shares. If we take the company on the right, these are some forecasts of the company, and we assume we make an investment in ordinary shares at the beginning of 2015. If we invest as ordinary shares, we see that our return is only 25%. If we invest as preference shares with a 4% coupon, our return increases to 29%. So comparing the two options, if we make our investment as ordinary shares, we get a 25% return, and the investor ranks the same as the ordinary shareholders. By putting it in as preferred shares, the return increases to 29%, which is quite material and can make a difference between the two types of investment. The coupon is paid in priority to the ordinary dividends. The investor ranks ahead of ordinary shareholders and can convert into ordinary shares on exit. So as you might imagine, many private equity investors are very keen to use preferred shares because of the protection it affords them. Mezzanine investors look for something different. They are lending money in substance, and what they're looking for is a premium interest rate and also equity warrants for a percentage of the company as a so-called kicker or sweetener. The debt ranks between senior debt and preferred equity. It has no or limited collateral, so the lending is based upon the cash flow of the company. And mezzanine funds will have this advantage over senior debt lenders because of their flexibility. Senior debt providers are usually banks, and they're restricted by the central bank as to how they can lend. And what mezzanine will do, it will fill a gap between the return expectations of the private equity fund, which are quite high, and the lending limits of the senior debt, in the case of a deal structure which involves debt and equity. Let's consider the properties of mezzanine. From the point of view of equity, mezzanine looks like equity because it's long-term capital, it's subordinated to the existing senior lenders. The mezzanine investor has an interest in increasing the value of the company because of the equity kicker or the equity sweetener, and it's possible that the interest payments or the fixed coupon payments may be linked to profits. So in that sense, it looks like equity. It also looks like debt because we have an obligation to repay at the end. It's typically a bullet repayment. There may be a basic interest payment coupon, which is not performance related. The debt is tax deductible, and it's possible to introduce loan type covenants by the investor. This is a typical buyout transaction. In this case, a private equity fund is wanting to buy a company for, let's say, $100 million, but they're only ready to put up $20 million themselves, and they want to raise the rest from other finance providers. So the bank may say to the private equity fund, well, we're ready to put $1 for every dollar you put. So the bank is ready to put $50 million towards the financing, but they want $50 million to rank below them. And so the private equity fund will then go to a mezzanine provider and invite them to contribute $30 million. And therefore, from the point of view of the bank, they're happy to lend 50 because they have 50 below them, being 20 plus 30. And from the point of view of the private equity fund, it's like they've managed to borrow 80 because they've only given up a small amount to the mezzanine provider with the warrants, and they've kept most of the equity. So from the point of view of the private equity fund manager, the mezzanine looks like a loan. From the point of view of the bank, the mezzanine looks like equity. The coupons on mezzanine can also be used in a much more creative way because they're quite flexible. Coupons on mezzanine products could be linked to profits, so variable according to profits. They could be deferred, in other words, for the first couple of years, no coupons need to be paid because the company's cash flow may not be strong enough. They could be paid in kind. Instead of being paid in cash, they can be paid in shares, and they can be accumulated. So instead of being paid in cash on a certain year, they can be paid at the end, like a zero coupon bond. Options are a derivative instrument because they are linked to the value of an underlying financial asset. In private equity, it normally takes the form of a specific and a customized agreement between the parties. It's often used as an exit mechanism if the main exit, like an IPO or strategic sale, doesn't go ahead. And that would be structured as a put option to other shareholders, as by way of example. What are some of the uses and advantages of options in private equity? Well, there's almost no limit to structuring options to deal with deal obstacles. So there's an infinite flexibility created by options. They can be customized as the parties wish to deal with a specific scenario. It allows for pushing out some challenging issues into the future. So it allows some issues which may not be resolved today to have the can kicked down the road, so to speak. And multiple aspects of any deal can be enhanced by option. The valuation, the exit, underperformance, overperformance, and future fundraising. Let's give here 4 examples of using options in private equity. In the first example, the technology fund buys 20% of the company for $2 a share and is granted an option to buy further shares. Now, this could be something that is given to the tech fund because they're hesitating to buy the company at the full 35% of the company, and if they have an option, they only have to buy 20%, and if the things go well, they can exercise their option and increase their stake to 35%. If things don't go well, they only expose themselves to 20%. So that creates flexibility in the deal from the point of view of the investor. In the second example, we refer to a mature company, a larger mature company, and the private equity fund who's bought the company grants management an options to buy 2% of the company for a symbolic amount of $1 if they reach targets. And the advantage of using this, it's like a stock option plan. It aligns the interests of the management with that of the fund, so that the managers are incentivized to work harder to produce the results. In the case of the third example, the put option is there because it's very likely that the division that the fund has just bought, its main customer is going to be the corporate seller, and it may take 2-3 years to diversify the customer base sufficiently to reduce that risk. And this option allows the fund to be protected from the corporate seller cancelling the contract with its former division and leaving them without any customer base. The final example, a fund which has 40% and the entrepreneur has 60%, the fund has a call and put option on the shares priced on a profit multiple. The company is managed by the entrepreneur. In this case, the reason for this is that if it was just a put option based on a multiple of profits, the entrepreneur who controls the company may be tempted to massage down the profit figure in order to make sure that the put option is very cheap for him to buy back from the fund. Having the call option will stop him doing that, because if he exaggerates in massaging the figures downwards, the fund could call the shares and he would lose control of the company. So it's a way to keep the entrepreneur honest. A convertible bond refers to the company issuing a bond or a debt instrument which then can be converted into an equity. And we can look at it theoretically like a bond plus a share purchase option. And sometimes this is used in some frontier markets because it can be a more simple solution than a mix of debt and equity, particularly for smaller transactions. And the advantage to the investor is that he can hold a convertible bond and be a senior bondholder. So if things do not go very well, he remains with a claim as a senior creditor. If things go well, he converts his bonds and gets the upside benefit.
One of the problems faced by parties to a private equity deal can be that in specific jurisdictions or countries, some of the things that the parties plan to do to structure the deal may not be permissible or may be problematic. This typically happens in jurisdictions where there's less familiarity with private equity, jurisdictions where the legal system is less reliable, or jurisdictions which are considered emerging markets or even frontier markets. And the approach to this would typically be that the parties would, by agreement, set up an intermediate holding vehicle in another country, which will then acquire 100% of the shares of the company in question. And then at the level of this intermediate vehicle, the parties would enter into all the arrangements between them, the shareholding structures, the classes of shares, and all the various other arrangements. So from the point of view of the country where the company is originally located, they will simply see a holding company in another country which owns 100% of the shares. And this is a typical way used by private equity funds to structure deals when there is some difficulty or challenge in the country in question. And so we can see examples of that in Central Europe would be that the parties might make use of a Netherlands holding vehicle or a Luxembourg holding vehicle, which would own the asset in Central Europe in order to have more flexibility in the structuring. So the purpose of this, it's about flexibility and achieving the deal structure objective. It's not about tax evasion or any other such objective.
Question 1. Which type of instrument is considered to have low risk and the lowest IRR? Please select 1. A. Equity. B. Subordinated debt. C. Senior debt. D. Quasi-equity.
This reading concerning African rubber is an example of structuring a private equity deal in which we have two different types of investors with differing objectives. Namely, one of the investors is a commercial investor, a commercial private equity fund that wishes to find a good investment for their capital and earn a good profit on this, and is interested in investing in a private sector type of investment. And the other investor is an impact or a social kind of oriented investor who is looking to have an impact on the wider community. And this deal structure is one that reconciles their differences and their different objectives. The case of the cleantech restructuring is another example of a private equity deal structure. In this case, we have a situation where the owner of the company has overextended himself and is in financial difficulty and has debts towards the bank. And the bank has a decision as to whether they should put the company into bankruptcy and try and collect on their loan. And the third party to the structure is a private equity fund specialized in investing in companies in difficulty. And this example is a good case of the three parties coming together and structuring a deal that reconciles the differing objectives of the parties. The entrepreneur concerned with keeping control of his company and keeping his company going, the bank concerned with trying to recover as much of their loan as possible, and the private equity fund looking to make a profitable investment.
In this section, we consider what are some of the main obstacles to successful private equity deals and how these can be overcome. The first obstacle may be valuation, an unrealistically high valuation expectation from the seller. The way around this can sometimes be that we structure a deal using a ratchet mechanism, preference shares, and option structures. Control. There may be an issue that the seller will not be willing to give up control of the company. Structuring for sharing control is one of the expertise of private equity investors by using board seats, veto rights, dual reporting, flipover mechanisms. Image. The seller may be concerned with losing face in his business community. Often the obstacles in private equity deals can be a question of image rather than substance. And for this, a private equity fund manager should have sensitive cultural and emotional antennae to pick this up. Exit concerns. The seller may not be ready to exit a few years down the road. Structures from partial exits can be deployed, and it can also allow for the change of mind over time, which often happens with entrepreneurs at the beginning of the transaction period saying they don't want to exit, they want to stay with the company for the long term, and then they will change their mind when they see the prospects of a major liquidity event. Complication in deals. A big part of private equity skill is communicating and educating parties less familiar with private equity structures, at the same time being careful not to get into the free education business. Questionable business practices. In some markets, business is done with less transparency. The key here is to manage a transition to better governance rather than an abrupt overnight change. In this section, we consider some very specific private equity deal structuring aspects, such as veto rights, flipover mechanisms, escrow accounts, and others. Board representation in private equity. The private equity investor may be given seats on the board in some proportion to the percentage of the investment. In addition to that, there may be the possibility of veto rights. In emerging markets, and in many other markets indeed, board members are in place for a variety of reasons. A board is not the same as a functional senior management. Board members are not there because of professional expertise. They may be there to represent their shareholders' interests. They may be technical experts. It may be a reward for political service in the case of a company which has a state ownership. They could also simply be family members of the main CEO or the main entrepreneur. One of the questions which it presents itself, the private equity investor, is should the board representative on the side of the private equity investor be an investment officer from the fund itself or an independent director, especially subcontracted for that purpose? From the investor, it can be more simple and the clearer role because he's there to protect investor interests. The independent director is an opportunity to bring to bear a greater expertise and to reach out to others who may have a lot more to contribute. One thing that a private equity investor is very good at doing is, in the case of them owning a minority stake, a significant minority stake, which is very typical, they can put in place mechanisms to protect their interests. So if we consider what levers of power a majority shareholder has, it's control of management and a majority in the shareholders' assembly and typically a majority on the board. A minority shareholder may have a blocking minority in the shareholders' assembly, veto rights on key decisions, and a voice and a vote on the board of directors. Veto rights are company decisions which cannot be made without the approval of the investment director, even if the fund is in a minority position. Veto rights are typically expressed as a list, and they would include raising debt, management remuneration, capex spending limits, selling of assets. It's sometimes useful to have veto rights which would also include more minor items, so they're more likely to be exercised, and which relate to senior management remuneration and benefits. Veto rights are usually expressed in a shareholders' agreement. Other private equity mechanisms and deal structuring instruments include drag-along rights, which is an agreement according to which one share block can oblige the other block to share with them if the offer is on the appropriate conditions. Tag-along rights, this means that one share block can join the other block if that second block has received an attractive offer for their shares. Return floors and ceilings, one of the block holders can enter into an arrangement with the other to guarantee him a minimum return in exchange sometimes for capping their upside. Regarding enforcement, private equity funds pay a lot of attention to enforcement, and particularly in emerging markets where the rule of law and the familiarity with private equity is lower. And what can happen in the worst circumstance is that the situation becomes frozen while the dispute goes into court, and indeed the foreigner may also feel themselves to be at a disadvantage. And this is particularly the case in some emerging markets like Central Asia, for example. The larger deals tend to rely more on the agreements, whereas the mid-cap deals need more focus on enforcement. And the main mechanisms to guarantee enforcement are using escrow accounts in the deal structure, having pre-signed powers of attorney on decisions, and making use of personal collateral. How does an escrow account typically work in private equity? Well, the two parties, let's say the entrepreneur and the private equity fund, will jointly select a third party who is objective. It would typically be a notary or a lawyer. They irrevocably assign to the notary the power to control some part of the shares or some part of the voting rights, if not the economic rights of the shares, under certain objective circumstances which are spelled out in an escrow agreement. The entrepreneur puts some of his shares under the notary's control at the time of the agreement. The shares stay under the management of the entrepreneur for the time being, and if a circumstance of a flipover is triggered, the fund will give proof to the notary, who will then transfer the shares to the fund. So here are a couple of examples of private equity deal structures. The flipover mechanism, if we refer to the previous slide, this is an example according to which the fund had 49% and the entrepreneur had 51%, and by putting 2% of the shares into an escrow account, which was administered by a third party, what was created is known in the industry as a flipover mechanism, and this is a mechanism according to which if an event happens that triggers a flipover, it's possible to exercise this mechanism very quickly and not involve a court. Another example of a structure is a Pac-Man structure, and this was a mechanism according to which the investment was structured as a preferred shares with a coupon rising very much after a certain period, which incentivized the other side to seek an exit. And the private equity fund obviously was concerned that the other side was not going to be motivated to seek an exit unless this mechanism was in place. Question 2. What are considered protection and control mechanisms for minority shareholders? Please select all relevant answers. A. Management control. B. Blocking minority in the assembly. C. Veto rights on key decisions. D. Board seats and votes.
This reading or exercise is to do with trying to solve a problem of objectives between the parties that seem initially not possible to be reconciled. In this case, we have an entrepreneur who is looking for a substantial investment but insists on it remaining a 50-50 partnership. However, when the fund is looking at it, it seems that it's very difficult to reconcile a 50-50 partnership with the amount of the investment. And this is a good example of how the PE fund uses a creative approach to structuring and using different types of financial instruments in order to reconcile the differing objectives. This exercise, the VC funding round dilemma, is a typical situation you might find in the venture space, in smaller companies, where in this case the founders have an idea about the valuation of their company and about the future performance of the company, which is vastly different from the idea of the investor, who sees the potential of the company to be somewhat more modest and has a very different idea about valuation. And so the question is, can we reconcile these two points of view? And here we have an example of a deal structure which can achieve exactly that. So allow an investment, but not insist on reconciling for the moment the two very different points of view of the parties. So finally, I would like to express my thanks to the World Bank for allowing me to share a version of the course that I developed with them and put it online on my website, on my LinkedIn profile. So thanks for that. Secondly, all the modules, this module and all further modules, will have a certain amount of case studies and additional materials attached to the module, which are part of the learning experience. These materials I will be posting on a specially created group that I have made in LinkedIn called Gavin Ryan PE Course. All you have to do is search Gavin Ryan PE Group, and the group will come up for you to join. You who are following this course, you'll be eligible to join my group and get these additional materials once you've connected to me on LinkedIn and once you've subscribed to my YouTube channel. So when I receive a request to join this group, I will check these two things and then I will admit you to the group. So thank you very much for your attention. I hope you've enjoyed this module and I look forward to seeing you on the next module.